This is my financial disclaimer so I don't get sued.
Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. Let's take a look at what we're covering in today's video. In this video, I'll be going over the data sets, the earnings, and doing a technical analysis over the SPY for the week of March 2nd, 2026. And after I do the SPY technical analysis, I will be going over, um, you know, what's going on with the conflict in Iran and potentially what could be going on with the markets due to that. With that said, I will be doing my live streams Monday, Wednesday, and Friday. I do plan to fully do the Monday, Tuesday, Wednesday, Thursday, Friday streams. I just have to get my health a little bit better and get my schedule back in place and everything, and I'll be looking forward to doing those. Other than that, with that said, let's go ahead and jump straight into the data. Now, we don't have a whole ton of very crucial data this week. It's truly later in the week on Friday, and it's really only at the 8:30 time slot. So, um, a lot of this week's going to be pretty much a lot of the narrative from what's going on with Iran, things like that. We do have some key data sets in here though, so we will go over that. So on Monday, 10 a.m., we have the global manufacturing PMI and the ISM manufacturing data. The ISM non-manufacturing data is at 10 a.m. on Wednesday, so that's the other side to that. Other than that, there's really nothing else on Monday. We do have the Atlanta Fed GDP now, but I'm really not too worried about that affecting the market anyway right now. On Tuesday, we have two Fed speakers. So at 9:55 a.m. we have Fed Williams, and 11:45 we have Fed Kashkari. Really, I have no comment about that, but really a very calm data day overall. Now for Wednesday, this is starting to get into the busier data days, but still not too important. At 8:15 a.m., we have the weekly ADP employment change. Again, that's been very low. This is going to be the monthly change, so this one's actually fairly important. I was thinking this was the weekly. This is actually the monthly, so this is important. It should be coming in fairly weak. The forecast has it up at almost 50,000. We've been seeing the ADP numbers and they haven't been anywhere close to that. So I don't expect that. I'd be very surprised if they're up near that point. Now, with that said, at 10 a.m., we again have the global services PMI and the ISM non-manufacturing data. So the other side of the Monday data, really again, I'm not anticipating a whole lot from this. This isn't the type of data that's going to really move the market a whole lot right now unless we see something very large with the non-manufacturing employment, but I don't really expect that. At 2 p.m. we have the beige book, and that's not really something I'm looking forward to too much this time. In terms of the overall Fed talking to business leaders and everything right now. Um, I think the Fed is pretty much set on just staying neutral. We're now quote unquote in a war. So, um, there's a lot of things that are going to take place to that. Whether it's a very quick conflict where, we're just going in with precision strikes and that's kind of it, or if this is going to be something more prolonged. We really don't know yet. And um, with that said, I don't think that the Fed is really going to be trying to move things around too much, as well as we have Powell being replaced in, I believe, May. So I don't really expect a whole lot from the Fed right now. Now for Thursday at 8:30 a.m. the jobless claims as always. Now we kind of have a whole lot of data at 8:30 a.m., but really nothing super important. We had the exports and imports. We've been seeing the imports just continuing to climb, which will continue to boost the GDP until those imports start actually being used and going down. It's going to just be a net positive for the GDP. Other than that, nothing really super important there between the exports and imports. We also have the non-farm productivity quarter over quarter. Now that is important. It's only marked as a two-star thing, but it doesn't matter. It it is important because it's showing, obviously the productivity out of non-farm employees. It's very crucial, and they're expecting this number to not be very good. The forecast is expecting a 1.7%, while the previous was 4.9%. So very cool overall in terms of that data set. Now we do have Bowman speaking at 1:15 later in the day, but I'm not, really worried about whatever Bowman has to say. Then for Friday, basically all of the data is all at 8:30 a.m. So it's the non-farm payrolls, the unemployment rates, the retail sales data, the retail control data, all that very, very crucial data. Um, we'll go over that closer to Friday. This is obviously extremely important data. I do expect a lot of cooler data overall, but overall the labor market has really been in this staunch stance of no hiring and very, very low firing. And besides, companies that are actually actively doing layoffs or having major issues. But if there's companies not having major issues, then they're really, really basically just not hiring anybody and just trying to keep the fires, low as possible and keep their head count, remaining and slowly dwindling head counts. Nothing has changed in terms of the labor market outlook overall. So I think that's the most important sentiment, and anything we get this week really won't change that either. We have been seeing the weekly jobless claims pulling down quite a bit. However, the consensus really is that that's just the lack of people um, truly being able to actually re-enter the labor force again. There was a statistic that I saw. I believe it was from Bloomberg. Don't quote me on it. I don't have it right at tips of my fingers, but it was something very, very large, like 25% of all unemployed, uh, you know, people that have been looking for work within the last 6 months have not been able to get a job, which is very, very, very extremely alarming. So we'll see really this start picking up in one direction or the other once we either start seeing either major hires start picking up again or major layoffs start. We're really just in this stance of everybody's just kind of turtled up and waiting for the next big thing. So either they're waiting for the economy to really pick up or they're waiting for the economy to really, start presenting itself and showing that it has been cool. Now, for our earnings this week, we do have some bigger names on here, but still overall, it's not the biggest week in terms of earnings. Really, the large week was last week with Nvidia. With that said, we do have ASTS on Monday. That's a fun one. I know many play that. There's Archer. Again, I know many trade that as well. Not really seeing anything super, super key in there. Tuesday. Target, I do want to read the guidance on that because obviously they deal with a large, amount of the overall public. So being able to see what their guidance is for overall consumers is really important. CrowdStrike after close on Tuesday. That's a very, very big name, but I'm not really worried about the earnings. Wednesday, we do have Broadcom in the afternoon. That's going to be a very, very, very crucial earnings. Now, I know semiconductors have been overall pushed up pretty high. I know there's been, a little bit of a sell-off kicking off here, and we have been talking about this potentially starting up. However, um, Broadcom is still an extremely important name. It may not be one of the top mags in the overall, what you know what I'm trying to say. It may not be the top name in the overall mag. However, it's still one of the most important companies on the planet right now. So, um, definitely pay attention to that. Friday or Thursday, let's see. There's Kroger. I'll obviously like to read the Kroger guidance. Same thing because of Target. And on Friday, there's really nothing important. So, really, this week it's Broadcom for the major earnings. There is Rigetti if you want to play Quantum, but I have no faith in Quantum right now. I've talked about that. Now, here is the CME for March. Loaded again, I apologize. So again, last week this did pull down to 2%. During one point it says it was closer to 8%. Incorrect. We were watching it the entire time. It was down much closer to the 2% range. So it has pulled up just a little bit. Now, again, in terms of statistics, this is still looking, immeasurably like a pause here. We can still have things start to kick off though. Again, this is the slow season in terms of overall retail sale or excuse me, in terms of overall retail sales, in terms of hiring, firing, things like that. So while this currently is basically set as a pause for the March FOMC, this can shift quite a bit, especially if we start seeing the Bank of Japan having to unwind positions to intervene within the yen, then a lot of different factors can occur. But currently, within the exact moment, it's at a less than 5% chance, and basically this is a 0% chance. If this is not closer to that 80 percent, then it's really basically a zero. So overall, not a super busy week for the data, not a super busy week for the earnings, and you know, um, CME has not shown us anything very crucial.
If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime.
And getting into the technical analysis, as always, let's ensure our daily time frame is turned on and our moving averages and Bollinger Bands. Now, we did have a selling day on Friday. We talked about this last week, how we were starting to have these moving averages have extremely heavy consolidation. We're seeing the 20 mile starting to pull below this 50 mile range, which last week was really basically the battle range on that. Now that we're starting to heavily pull below that range, it's telling the market that the 5 mile, the 10 mile, the 20 mile all need to be pulled below this 50 mile range, which that's telling us that essentially the range that we've been trading at for the last 3 months is no longer acceptable. That's really what being below the 50 mile is. The reason why I say that is because it's based off of 50 trading sessions. 50 trading sessions is generally 3 months. So it's basically the 3 month moving average if you were to think about it that way. So the 3 month moving average is consuming our weekly, bi-weekly, and monthly moving average using, the 5, 10, and 20 month. Very bearish signal here. Okay. And we talked about this again, and I don't like to mention that, but, we talked about this again the last few weeks where the last time we saw this was back in um, early March, late February. Almost the exact same time we're starting to see this now. Um, However, it was kind of a lot different territory back then. We were already starting to sell off. Um, by this point, we already had the 5 mile well below. the 50 mile, we had the 10 mile well below the 50 mile. And by the time the 20 mile started to cross below the 50 mile, the sell-off was almost halfway complete by then. It was already starting to head down towards its second leg of the major sell-off. Um, Far different conditions than what we're at right now. Uh, with the conditions we're at currently, we haven't even started the sell-off, and we're seeing the 20 mile and all of our short-term moving averages pull below that level. So the last time that I truly saw this was back, and I have to really pull this back here. It was back in 2022. Let's see. It was back in here. Okay. And I remember trading this very well because it gave us some very, very awesome opportunities, especially Sparky, Sadis, and I. If you're in the Discord group with us, you've been, this is how this group was started, was back in this bear market. This was how I became a trader, was back in this bear market. So, um, I know these movements very well. With that said, that was back when we had the true bear market. Now that bear market lasted all the way until we had Nvidia really break out with the earnings, and that was after the bank blowups and everything else. If you remember the 2023 regional banking crisis, you know, that was, let's see, that was earlier in the year. I want to say that was this candle back in there. But as you can see within that bear market, selling, buying, selling, buying, selling, buying, selling, buying. A lot of up, down, up, down, up, down, up, down price action. However, we can still determine, exactly when to buy the dips, when to sell the tops. And with the bear market, now again, we're not fully in a bear market. Um, this will change our perspective on things slightly, but if we see a continuation within our bear market, buying these bottom dips become not the best opportunities anymore. Um, it does become a super, super great long-term opportunity, because generally buying the lower Bollinger Ranges are usually going to be very, very profitable. However, buying the lower Bollinger Ranges during this bear market, um, we went all the way from the 450 range down to the 300 something range. Okay, it was a very, very extreme, amount of selling. However, with all those selling opportunities, with all those buys, you know, you would have been positioned into, you know, technically the largest rally in human history. Excuse me. With that said, um, these conditions are starting to get very bearish here. We're starting to see the moving averages being pulled under the 50 month, and we're starting to see a lot of that reflective buying and selling, buying and selling, and buying and selling, just like a bear market does. Now, we're not fully there yet. Again, we do truly have to sell off. Um, but this is really making the top of what could be, a bear market. And a bear market could last a few weeks, it could last years. Um, we don't know how long this could last. So is this the top of the market right now? It's starting to really look like it, which is kind of unfortunate. However, with that said, one major, major feature here is that the ADL has been pulling up very, very large on the daily time frame, which does say that there is money entering into this. However, with the moving averages positioned where they are, we can't ignore that this is turning extremely bearish. Now, with this bearish price action, we've seen over the last week, we've seen the 5 mile tested, 20 mile tested, 20 mile rejected, 5 mile tested, 5 mile rejected. Okay. So where that puts us now is that with the 5 mile being rejected, and again, we did talk about this last week quite a bit, is that we did anticipate this type of price action almost to a T. Is that with that 5 mile rejection, this really turns the selling pressure on, because now the downside is starting to fill each of these gaps. So fill that bottom gap at the 675, fill that gap at the 669, fill the gap towards that 648. And again, um, what's at that 648 range? It's our 200 mile. So turning on the drawings, and I'm sure they're probably going to look like a mess, so I apologize in advance. I don't. Okay, I don't apologize. They look fine. Um, we have this big d- deep red liquidity range down here, which really I have my eyes set on. I do think that's where the market is heading, at least in the short run. And by the short run, I mean the next month, month and a half. So I would be preparing for that downside. Um, the next move from here, though, is that we are within this consolidation channel. And with us being in that consolidation channel, with us rejecting the top, is that we should be anticipating to pull all the way to the bottom of this consolidation channel. The bottom of that channel is at the 674, essentially. It's a little bit below that, but you could say it's essentially at that 674 range. After that, we need to pull below that range, build some support below that, and then start pushing into the lower Bollinger, up to the 5 mile, lower Bollinger, up to the 5 mile, rinse, repeat, rinse, repeat. Um, and that's how a lot of that selling will, you know, push us downward. We'll start seeing tests up to the 20 mile. If we see the rejection from the 20 mile, then we can anticipate to push all the way back down to the lower Bollinger. Sort of like when we had the very, very bullish price action, where each time we'd push down towards the 20 mile, it'd be major buying to the upside. Well, once we start turning on the selling pressure, that flips. So each time we pull to the 20 mile, it'd be selling to the downside, pull to the 20 mile, selling to the downside, until we finally hit that range or, within the narrative that we're no longer in that sell-off. Okay. Very, very concerned with this. I do not see buying in the current sense at all. And I just want to show this a little bit further with some of these structures here, is that on the 4 hour time frame, which you could follow along on your hourly time frame if you'd like, is that there has been massive bearish structures. There was potentially bullish structures in here, but we talked about this weeks ago. They were invalidated. With those being invalidated, that creates a massive amount of room to the downside. Um, from here, we are seeing, and I apologize for all the drawings again, but I do need to draw this, is that we do have this potential head and shoulders going on. Okay. Now, with the overnight selling, it is showing us that potentially we could be pushing down further here without building this right shoulder. However, with how liquidity works and everything, I fully anticipate this right shoulder to be built. And not only for this right shoulder to be built, but for that right shoulder to be created from a rejected 5 mile test. So we have the 5 mile currently at says the 687. I anticipated pulling down a lot closer to that 680, 680-ish range. So from where the overnight market is currently, it's currently at 681.40. That could be pulling up, again, all the way towards that 687 range, doing a test within there, and then rejecting back down to really see the continuation within that larger head and shoulders. So that's what I'd be looking for. I would really not be trying to um buy into this too much in terms of trying to catch the upside. This is not the the market to be doing that. The moving averages here are telling us that the buying has weakened over the last 3 months. Um, which is a very significant thing for the market because I forgot the exact statistic, but I believe it's, 80 something percent of the time the market is in a buying posture. So that is a very, very bearish signal overall. Not something to ignore, especially this blue liquidity range. We rejected it to the T. With that rejection, we've just been seeing the selling sentiment downward. Now, we can have a little bit of a bounce here. And again, this would allude to that 5 mile test to the upside and creating the shoulder or that larger head and shoulders to the downside. Um, if we get this right shoulder, if you haven't loaded puts for at least a month, 2 months out, that's kind of your opportunity to take it. So, um, that's what we will be pricing out over the next few sessions. So definitely look forward to that. But I would expect a major rejection within this range. The opposite situation is that this does turn bullish somehow, and we start filling this cup back up to the upside. Um, Again, that would require us to start pulling the moving averages back bullish. That would require us to break above the consolidation channel top again and to once again pull back into this very, very scary blue liquidity range that we have not been able to break through. Um, so that's really what I'm expecting out of this week. And again, our short-term target is not exactly this 650 range, but that's going to be our target over the next month and a half if this sell-off is really going to happen as I think it is. Um, the short-term target would be to build that right shoulder, pull down, break below the consolidation range, pull that 669 range, and then start below or start pushing below that. But we do have some room prior to that. And the reason why is because we do have to get through the lower Bollinger first. So even though things are turning very bearish, we do have to push into the lower Bollinger, have the Bollinger mechanics, play out there, buy upward to the 5 mile, retest the 5 mile, very, very likely reject the 5 mile, push back down the lower Bollinger, rinse, repeat. So there is some, movement that actually has to occur within the moving averages. So it will take some time if there's going to be that selling to the downside. I wouldn't just expect a, you know, single candle downward type trading session. That's really not how it works for the most part. So yeah, that's going to be the SPY technical analysis. Now, I did want to very, very quickly take a look over oil. So, taking a look at oil, and I will circle back around to some of the volatility instruments and everything after the fact. However, this is USO, so United States Oil. You can go over one of the many different oil symbols. There's the futures. It's another good one. Hold on. There's an actual futures that I want to show you here. It's the MCL main, so the crude oil main. Um, However you want to trade it, it's up to you. So we have this cup building to this 83 range, and this is on the daily time frame. We should be fully anticipating that cup to be built up to that 83.50. And with that cup being built into the 83.50, that does create this move into the upper Bollinger. With the upper Bollinger, currently the upper Bollinger is at the 82.57. So with that, we can expect the upper Bollinger to push about a full $1 to $2 above that range. We're seeing the overnight price action pulling us all the way up to the 86, which is above here. So technically tomorrow we should be within that upper Bollinger day 1. From the upper Bollinger day 2, that's when you'd start to look for a short position. Now, I know people are thinking, oh, you're crazy. you're going to short oil when, there's a war going on. Um, that's not what I'm talking about here. I'm just talking about upper Bollinger mechanics and overall creating the top to this cup. For any cup, you know, um, doesn't matter how bullish the symbol is, we do expect bear structure at the top. From that bear structure, that is how we get our handle downward, which is how we create the bullish liquidity to continue pushing into new highs. So that's what I'm expecting. I'm expecting that day one upper Bollinger push, secure the upper Bollinger. Based on the overnight price action and everything, very likely we already are going to see that. Day two, see a push into the higher high. And from that day two to day three, day four, start seeing the consolidation back down towards the 5 mile. Okay, from the 5 mile, that can be a major test to the upside or a major bounce to the upside. So even though I have this handle drawn down pretty large, it doesn't have to go down that far. It could be, a very, very small handle to the upside. So oil does look good. I would not try to short until we get that upper Bollinger day two. Um, if you're going to short oil at the upper Bollinger day two, which I'm going to because I'm crazy, then just remember that that is basically the upper range of what we've been seeing all the way since 2022. So potentially a very, very, very good shorting opportunity. And the way I'm going to short that is I'm going to go into SCO shares, which is let me get it off the weekly time frame. It's the ultra short crude oil shares. So um, currently in the overnight, these are at $13 a share. And this is essentially showing these are bearish shares, so they gain once oil drops. So when oil drops eventually, which it will, that's how oil works. Um, this is done reverse split, so I'm not really looking at that. But when oil drops, we can see the share price almost double, um, if not go up further. But truly, my expectation would be to pull back up into that, 19, 20-ish range, which is, a full $8 upside per share, roughly. So there's a lot of opportunity here. And once we do get the upper Bollinger day two within oil, um, the share price on this might even be at, 11, $12 a share. So could be a very, very quality long opportunity. And with it being pushed so low, in terms of, or, with oil being pushed so high, I would not really be too worried about going, for a longer short position within that. So that's what I'm looking at for that. Now, I do want to very, very quickly circle around to the whole Bank of Japan thing because that is still a concern. We're seeing Bitcoin, the overnight having a little bit of selling still, so that is still showing that the equity weight can be weakening still. This is the FXY, so this is the yen. Um, Again, this is the weekly time frame, and each one of those lines are showing the previous unwind events. So that's in 2024, 2025, and with the yen being pushed down this low, it's extremely likely we're very due for a major unwinding event anytime now, especially when we're seeing all the selling within overall tech and everything. That's exactly when the Bank of Japan tries to time the rest of their selling as well. So I do really expect this major unwinding event to occur, and once this does occur, that will cause the SPY to sell off quite a bit. So that does go hand in hand with our thesis that potentially this might be the top currently of the SPY. And this is showing those previous unwinding events. So that was that 2024 and the 2025. And, you know, potentially we could be seeing something even larger. I don't really assume that this time. I know that the tariff correction was pretty large. However, with how the moving averages and everything have been placed on this SPY, we could really be seeing a pretty deep correction here. Now on the VIX, we've been seeing the VIX starting to pull back up towards that $20 range. And to sort of show a correlation with this, and let's see, back in 2022 is when we really saw sort of that same sort of price action where we were sitting below that range, and then we really entered that bear territory, that bear market. And when we were in that bear market, volatility was extremely elevated the entire time. Now, we're not there yet, but it is starting to look like that we're getting ready to re-enter those type of conditions. So that can create some very nice trades in some of our volatility instruments. So just be aware of that. But this is something to monitor when you know, we still have our conditions that are showing that major selling can occur. We still have the VVIX well above that 98 range, which is telling us that selling is extremely present. And until we see this pull down massively, that selling is just going to be, you know, constant at that point. So there's a lot of signals that are really telling me that I really think that we could be entering into a very large correction slash bear market here. So all right, that's going to be the video for tonight. Um, with that said, I will be trying to stream again Monday, Wednesday, and Fridays until I can get my sleep schedule and my health and everything feeling a little better. Last week I felt absolutely awful, so I could not keep my schedule up at all. I do apologize for that. Um, with that said, thank you all for watching. Thank you all for supporting me in what I do. And I am working my best to be able to, do those live streams, the live classes and everything else. So, um, thank you. Thank you for your support, your kind words, and everything else. Thank you for watching the content that I do put out, even though it's not as consistent as I would like it to be. So, thank you. With that said, that's going to be tonight's video. I will talk to you in the next one. So, take care, everybody.